started. Hi, everybody. Thank you for joining. I am Christine Brannon with your current president for Mortgage Bankers State of Arkansas. And we've got special guest Mike, and I'm going to say his name wrong, Frattanoni. See, Mike, I'm going to need you to say it.
You were there, Frattanoni.
Frattanoni. He's the chief economist for Mortgage Bankers Association, and he is here to give us a mortgage update, economic update. So welcome, and thank you for coming.
Oh, thank you very much, and good to be with everyone today. So my plan is to sort of walk you through how we're thinking about the world right now, both from a macro standpoint and some of the mortgage and housing market trends that we're watching. For those that do track our forecast, pretty similar to what we've had the past couple of months. So looking for growing origination volume this year, and that's really largely due to growth in the purchase market. But we think, given some of the volatility in the world we're seeing today, there are going to be some refi opportunities as well. And this week might be one of them, given some of the recent downturn in rates. But let me just start with the big picture. Thinking about where the global economy is, you have central banks around the world cutting short-term rates in the face of really quite weak global economic growth, really everywhere outside of the United States. The curious thing is that while the rates that central banks directly control, short-term overnight rates, have come down, we've generally seen longer-term rates increase. And this is just a chart showing for the US, the path of the 10-year Treasury yield and what it's done in prior Fed rate cutting cycles. Typically, when the Fed cut short-term rates, longer-term rates dropped, but sometimes they stayed relatively level. This time we've had this really odd circumstance where short-term rates down about a percentage point in 2024, but 10-year yields up about a percentage point. So what on earth is going on? And important to recognize that it's not just the US. Other developed markets are seeing the same thing, with short-term rates going down, but longer-term rates, including mortgage rates, going up. And a lot of this happened immediately post-election, when global investors seemed to sort of recalibrate what they were expecting for the next couple of years, looking for somewhat faster growth, somewhat higher inflation, somewhat higher deficits, and as a result, we've seen upward pressure on rates. And I do think it is reflecting sort of a newfound sensitivity to deficit and debt pictures, and again, not just in the US, but around the world. So if you're following some of the political debate in the United Kingdom or France or Germany, or really all across Europe, but certainly also in Asia and other parts of the world, just much more concern about government's ability to continue to finance large deficits and debt, and that's certainly impacting the US as well. So let's focus in now on the US, and first just looking at overall economic growth. And this is looking at GDP growth going back the last 15 years or so. And you can see a couple of things on this page. One, the sharp but short recession that we had in the pandemic in 2020, and then the very strong rebound in 21. That really wasn't surprising as the economy opened up again. What has been surprising, though, is that growth in 22 through 24 stayed really much stronger than we or anybody else had been forecasting. And that really has persisted even through the fourth quarter of 2024, where we saw better than 2% GDP growth. Our expectation the next couple of years is that growth for the US slows a little bit, so down a little below 2%, And again, a lot of this is just in a context of a global economy, which honestly is not growing outside of the US. If you look at Europe, it's been stagnant for about 3 years now. Same is true in China, sharply slowing growth for a number of factors. And that's really beginning to weigh on the outlook for the US as well. So GDP growth, one thing, let's get a little more tangible. Look at what's going on with respect to the job market. And you see the same pattern of, relatively modest growth last decade and then a huge amount of layoffs during the pandemic. Most all of that recovered in 2021. And again, what's been surprising is just how fast employment growth continued in 22, 23, and then the light blue bars are showing 24. And you can see their average of 186,000 gains in jobs per month through the course of 24, with a particularly strong month in December with 256,000 gain. We will get the January numbers, so first month of 2025 tomorrow, and market expectation is for something on the order of 200,000 gain. And I'm not going to be surprised if that slows somewhat over the course of 25, in line with our expectation for somewhat slower economic growth. Now, all of that fantastic payroll growth we had over this last couple of years led to a very steep drop in the unemployment rate. That's the orange line here. In the spring of 2023, we got to 3.4%, which was the lowest we'd seen since the late 1960s. Since then, it's edged up as much as 4.2% in November. It was back down to 4.1% in December. I'm not going to be surprised if it increased a bit in January, and our forecast is over the course of 2025, it's likely to increase to about 4.5%. So historically, that's not a high unemployment rate, but just a little bit higher than what we're seeing today. So you can see here how the unemployment rate in Arkansas has compared to the national. So Arkansas in red, US in blue, generally tracking a little bit below that national unemployment rate. And again, from this point, would expect a fairly modest increase both at the state level and at the national level. But y'all are starting from a strong starting point relative to the rest of the country. So what's the other big macroeconomic trend to watch? You have heard it endlessly over the past couple of years, and it's inflation. That whereas prior to the pandemic, inflation was really not something that we were worried about. And if you asked a central banker, they actually were a little concerned that it was too low relative to that gray dash line, which is their target for the inflation rate at 2%. But as everyone well knows, over the course of 21 and into 22, inflation really got out of hand. It was running as high as about 9% by some measures at the worst of it in 2022. The Fed reacted very strongly, brought short-term rates from 0 to above 5% very, very quickly. That's the equivalent of slamming your brakes on the car. And you can see that it has resulted in inflation coming down. Now, this is inflation, so prices are still increasing, particularly for things like eggs, as everyone is well aware of right now. But they're increasing at a slower rate. So depending upon which measure you look at, inflation is running at sort of 2.5% to a little above 3% at an annual rate. Last 6 months or so, it's just kind of plateaued a bit, but there's some technical reasons why the measurement may be overstating things right now. And our expectation is over the next 12 to 18 months, expect those lines to get down to that gray dash line and inflation to get back to the Fed's 2% target. But it certainly is not there yet. And so when you see our forecast for what we think the Fed's likely to do, they have been pretty clear that they're really in no hurry to cut rates further, given the combination of where we are with the job market and where we are with current inflation. Now, I mentioned that, we're thinking the reason why long-term rates have increased, it's really due to concerns globally about the state of government budget, debt, and deficit. If you look at the top line figures for the US budget, the deficit's running about 7% of GDP. The debt is about 100% of GDP. And if you look at these charts, which are looking at outlooks for government expenditures and government revenues, this newly released from the Congressional Budget Office, you see really the driver of expected further increases in deficits and debt is a lot more spending on mandatory programs, so Social Security, Medicare, Medicaid. The fact that now we have this enormous debt of, call it $30 trillion, and the interest on that debt, payment of that each year now exceeds what we're spending on national defense. And you can see the expectation is that just paying the interest on the debt is going to grow to 4.1% of GDP under current law. And this is assuming that spending on discretionary, which is all the things that you would think government focuses on, is likely to decline as a share of the economy going forward. The chart on the right, looking at revenues from taxes, this is under current law. And again, this is sort of government speak, right? But the notion is if the tax provisions continue as stated under sort of current law, you would expect a big increase in tax revenue at the end of this year. Why? Well, the Tax Cuts and Jobs Act that passed in 2025 had two major components: a cut in the corporate tax rate, which was permanent, meaning it'll stay at the 20.1% level it was set at unless and until Congress changes it. And then the individual provisions, which were cuts in marginal tax rates, a doubling of the standard deduction, a range of other features. All of those expire at the end of this year because they had a 10-year limitation put on them. If that happens, you get this big jump in individual income tax revenue, but it's not likely to happen. There was some partisan disagreement about exactly how to go about extending them, but the differences are relatively minor, frankly speaking. And the additional cost of extending those provisions on a budget scoring perspective is about $5.5 trillion. So you're going to hear a lot about these numbers over the next couple of months because Congress is already getting moving to try to decide how to handle this expiration before the end of this year. Another big policy issue that, again, is grabbing all the headlines is the potential imposition of tariffs on many of our major trading partners, including Canada, Mexico, China. There's sort of the short term, how that gets worked out. But I think the long term, as this set of illustrations is showing, is you can likely expect over the longer period of time less trading to be occurring between the US and particularly China, but perhaps some of its other trading partners as well. So a bit of a reversal of the globalization trend we've had the past couple of decades. That certainly seems likely given the nature of the conversation. So sort of the last piece of the macro puzzle is another monetary policy piece, which is looking at the Fed's balance sheet. The balance sheet peaked in the middle of 2022. At that point, they began to allow their holdings of treasuries and mortgage-backed securities to roll off passively. They've begun to slow the pace at which their treasury holdings are running off, but MBS can still leave the balance sheet at up to $35 billion per month. Expect that this is going to continue, but probably by the middle of this year, they're going to hold the overall size of the balance sheet steady, but they're going to continue to allow the MBS to roll off, but reinvest any of those prepayments and amortization into treasuries, again, for probably middle of this year on. Now, that's going to be a little bit sort of an ongoing crimp on demand for mortgage-backed securities, and it's one of the reasons why the spread between mortgages and treasuries has remained relatively wide. For much of 2023 and into 2024, that spread was as wide as 300 basis points. We're now down to about 230. Historic average is about 180. We do think it's going to continue to narrow somewhat, but the ongoing quantitative tightening from the Fed is going to keep it a little wider than what we've seen historically. Okay, so what does all this mean in terms of direction of interest rates? So start with the Fed, which is the green line. We're forecasting that they're just going to make one more cut this year. So they've cut 100 basis points thus far from their peak when it was at 5.25. Now they're down to 4.25. So one more 25 basis point cut down to 4%. And we think that's it for this rate cutting cycle. And the reason is that they need to keep rates more elevated than they would have thought a bit ago, just to keep inflation heading in the right direction. And at this level of rates, the job market still seems to be doing okay. So again, to all of Chair Powell and the other officials' comments, they're just in no hurry to cut further. With that kind of environment, and then with this tug of war between a very weak global economy and concerns about deficits and debt, the weak global economy pulling rates down, that's what we're, I think, really benefiting from this week. Now seeing the 10-year Treasury well below 4.5%. When investors get more worried about the debt and deficit picture, that's when we were at 4.8 just a couple of weeks ago. So our forecast for the 10-year Treasury is we'll average about 4.5% over the next couple of years, but really think about that as a trading range between 4 and 5%. Again, depending upon sort of sentiments of the moment, we're going to be at one or the other end of that range. In terms of mortgage rates, we're at about 6.7, 6.8 right now. Our thinking is that with a little bit of a narrowing of that spread between mortgages and treasuries, we're going to average about 6.5% over the next couple of years. But again, think about that as a range between 6% and 7%. And the same factors driving us lower when people are more concerned about global growth, and higher when people are more concerned about deficits and debt. All right, let's move now to what we're seeing in terms of the housing market. And I would say for our industry, this is generally good news that looks like we are finally seeing a turn in the level of inventory, the number of homes for sale, both on the new and existing side. And, you know, we've seen more than a decade now of just lower and lower inventories of existing homes. For the past couple of years, as the lock-in effect was really keeping many current owners from listing their properties, builders really sort of put their foot on the gas, and we saw the amount of new construction coming to market beginning to grow. But now both sides are growing. So the lock-in effect seems to be fading. And we're anticipating that this is going to support a stronger spring housing market in 25 than we saw in 24, because 24, 23, 22, we're very much supply constrained, and we're in a better place now. Again, looking at how Arkansas compares to the national, it really looks like a very similar story of inventory levels are up relative to what we saw a couple of years ago, are still below where we were pre-pandemic. And again, you can see here, very, very comparable in terms of the trends to what we're seeing nationally. So growing inventory should support more purchase transactions. For those currently in homes, we think, you know, at least at the aggregate level, we're not expecting home prices to decline, but similar to the story with overall inflation, we do think that the pace of home price growth is going to continue to slow. So nationally, home prices were growing at double-digit levels during and post-pandemic. In 2024, that slowed to 3.8%. We think it's reasonable to expect sort of 1 to 2% national home price growth over the next couple of years. And this is largely a result of that additional inventory finally making its way to market. Now, when home prices nationally were growing at double digits, every single market in the country was growing, was positive in terms of home price numbers. Even at 3.8%, you are seeing some markets, particularly along the Gulf Coast, that are seeing some home price declines, with Southwest Florida and some of the Texas markets being the most prominent examples. And that's where the level of particularly new construction inventory has really gotten much higher than the market can immediately absorb. I think all of those markets have sort of long run favorable trends, and that sort of inflow of domestic migration is going to continue to support housing demand there, but they just got a little ahead of themselves in the near term. Again, not a lot different with the Arkansas story compared to national. If you're looking at either home price trends in the most recent time period, again, down from that peak that we had in 21 and 22. And if you look on a cumulative basis since 2020, Arkansas doing just a little better than what the numbers show nationally. So home prices going up, good for current owners. They're building equity. For those trying to get in, it's been a real challenge. We put out an affordability metric using our weekly application survey data. We're looking at the median principal and interest payment for different types of loans and how that's changed over time. And it really is quite remarkable that if you go from 21 to 23 for different types of loans, we've added about $1,000 per loan in principal and interest over a very short period of time. And that was a combination of mortgage rates more than doubling over a short period of time and home prices increasing rapidly. Since that time, at least this this metric kind of leveled out at a time when wages are growing about 4% per year. And that's pretty positive. If you think, excuse me, we're now in a world where wages are likely to be growing faster than home prices. And for those folks that are trying to get to a point where they can buy, in many markets in this country right now, rents are essentially flat, if not declining. So you should be able to see some young households catch up for a few years here. Not all the way. We're not going to make up for that jump that we had in 2022, but should be getting a little bit better. And again, showing the comparison here, Arkansas relative to the national, given average home values, average loan sizes being a little bit lower, that purchase application payment index, that measure of affordability, looks a little bit more favorable in Arkansas. So what are we seeing in terms of current levels of activity? So here I'm showing you two data sets, two surveys that we put together. Our weekly application survey in orange, which is tracking purchase volume for the entire market, really dominated by applications to buy existing homes. And blue, the builder application survey, which is just applications to buy new homes. That new home metric, has showed consistent growth for much of the past couple of years. The broader metric was showing pretty significant declines right up until the end of last year. And now we're finally beginning to see some year-over-year growth, but really quite modest thus far. If you look just at Arkansas, it's actually a bit of a better story on the purchase side, where seeing more rapid growth certainly, and really over the course of 24, some actually fairly significant year-over-year growth in purchase applications. Refi side, much closer to what we're seeing at the national level. In terms of refis, I mentioned that hey, this might be your week for it. Wouldn't be surprised if you're getting some phone calls with folks inquiring again, because now we're well into the high sixes for conventional and the low sixes for FHA rates right now. And last fall in September, we just saw this enormous spike in refi application volume. And it didn't take much, right? I mean, our headline mortgage rate was still above 6%, but it was the low sixes as opposed to the high sixes, sevens, and even eights that we've seen the past couple of years. And it just sure seems like there are a large number of homeowners out there who know they had a relatively high rate on their current mortgage and are just waiting for that opportunity to jump in. And in a low six or a high five on an FHA was enough to get people to jump. And again, it was interesting. Although you see that average loan size, there was a jump. So there certainly was an increase in higher balance conforming and jumbo lending. There was also a big jump in FHA and VA refinance applications, streamline opportunities. And so, our expectation over certainly this year and then probably next year as well is this is what the rate term refinance opportunity looks like. It looks like a moment in time when rates drop due to some volatility related to sort of you choose the topic. Could it be geopolitical? Could it be political? Could it be related to some of the tariff discussion? Could it be related to sort of breaking economic news or financial market volatility more broadly? Whatever, when rates drop low, there are a bunch of homeowners out there who are interested. Outside of that window, there's going to be more of a steady stream of refinance from cash out refinance borrowers, given the amount of equity in the system right now, and particularly those that might not have ready access to a HELOC or for their particular situation, a closed-end second might be better than or a cash out might be better than a closed-end second. Putting all that together, what does that mean for origination volume? So we think that the purchase market, supported by growth in home sales, so about 5% growth in existing home sales compared to 24, 10% growth in new home sales, and growth in home prices, although at a much slower rate than the last couple of years, will lead total purchase origination volume a little above $2 trillion in 2025, compared to about 1.8 trillion in 2024. And you can see the blue is purchase, the red is refi. So this is going to be a purchase-dominated market really for the foreseeable future. And we see total origination volume growing from the 2 trillion in 2025 to getting close to 2.5 trillion by the time we get to 2027. So we do forecast both in dollar terms and in unit terms. So we're looking for 15% growth in dollar terms, so that $2 trillion number. We're looking for about 14% growth in unit count. So you can see that in 2024, we estimate the industry originated about 5 million loans. We are expecting about 5.7 million originations in 2025. So looking at that history, still not a strong year, but part of this sort of long, slow uphill climb we're expecting in terms of transaction activity over the next couple of years. And again, the blue bar bigger than the orange portion of the bar, saying this is going to be a purchase-dominated market. So the low level of volume has certainly constrained profitability for a lot of lenders. This is data from our quarterly performance report looking at profit margin on the production side of the business. And so you can see here 8 straight quarters where your typical IMB was losing money on origination. Many of them had servicing income, so on an all-in basis, they might have been profitable, but this just highlights what a challenging environment it's been, even as many lenders have really, really worked to try to contain costs. Second and third quarter of last year, again, your typical IMB was profitable on production, but that 17 and 18 basis point profit margin is less than half of the about 40 basis point average that we've seen going back the last 15 years or so. Fourth quarter is going to benefit from that rush of refis that we got in terms of apps in September. They probably closed in October and November. So fourth quarter number might look good. First quarter is always slow, so that might turn negative again. But again, we're hopeful that this spring we'll see some additional volume given the inventory. Now, I mentioned lenders really working to try to control costs. You can see that in green here on a dollar per loan basis. But even more impressive is if you look at the orange, which is instead of a per loan, it's a per company expense. You can see on a per company basis, we went from 41 million down to about 21 million. So IMBs really across the board really working to control those costs. But that per loan metric at 10,700 still certainly high compared to what we've seen historically. Some of that's just inflation, some of that's resulting from larger loan sizes and a sales force paid in basis points of production. But we certainly expect there's going to be a lot of focus over the next couple of years. One, more automation, more investment in technology, trying to bring that per loan cost down. Two, while we don't expect at the industry level for there to be much additional reduction in headcount, wouldn't be surprised if we see some more consolidation at the company level now that we're on an upward swing again, and you might see more owners of companies more willing to sell as valuations in their enterprises improve a bit. Again, companies of all sizes, both banks and IMBs have cut back. If you look at total FTE count, and this is our performance report data, so this is again that sample of about 350 independent mortgage banks, peak to trough reduction in employment of about 44%. So really, really significant cuts. And that blue line there showing that more cuts on the back office than among sales staff. So again, not expecting at the industry level more employment cuts from here, but do expect some company level consolidation. Couple other trends to highlight. One, in terms of channel mix. This is HMDA data, so we only have it through 2023 at this point. We have seen growing share going to broker wholesale channel from a little less than 10% in 2018 to almost 16% in 2023. I'm going to be very surprised if the 2024 data doesn't show further increase here in broker wholesale. So that certainly is sort of one trend, but important to note that we're still an industry that more than 75% of the volume comes through retail or consumer direct. So broker wholesale, a growing part of the mix, but still a relatively small part of the mix. And then on the servicing side, it's been really good news. I mentioned that servicing income has been a very helpful offset for a lot of lenders, particularly when their production business was very much struggling. But delinquencies have been extraordinarily low. So when the unemployment rate in 2023 hit that multi-decade low, in our survey of delinquencies, we hit an all-time low. But since then, as unemployment has risen, delinquencies have risen right along with it. And we just released our fourth quarter number today, and delinquencies increased again in the fourth quarter. Again, in line with what we're seeing in unemployment, and showing here our forecast of the unemployment rate getting to about 4.5% by the end of this year and leveling out. Would expect that delinquencies are going to follow that right up. Now, comparing what's happening in Arkansas to the national, yet again showing something that looks very, very similar trend. So hitting a low point in that sort of 21 to 23 period, and modest increases since then. And that's true of the 30-day delinquency rate, which tends to be most sensitive to changes in job market conditions. The 90 plus is really as much impacted by housing market conditions. So if you have a borrower that becomes delinquent, if you have a seller's market, for lack of better words, that they can sell that home, and you never see that delinquency progress further. If we're getting into a market where inventories are getting a little bit higher, it's going to be a little bit more difficult for that borrower to quickly exit from that property. So, both of these, I think, likely to increase somewhat over the year ahead, but stay historically relatively low. We are seeing FHA delinquencies increase more than conventional or VA. So the new number this morning is FHA delinquency rate up to about 11%. So well above what we saw pre-pandemic. But the chart on the right, foreclosure numbers, both starts and inventories, really extremely low. Looking into that FHA data, FHA does this wonderful report where they have information on the borrower's reported reason for delinquency, and you can see a lot of it's due to income being cut back or they're unemployed. But the growing one that I think is worth paying attention to is the gray here, the excessive obligations. So we're seeing very rapid increases in consumer debt, so credit card debt, auto loans, student debt, and couple that with very high debt to income ratios for a lot of more recent FHA borrowers. And I think it's really causing a challenge. So that's leading to those higher FHA delinquencies. You're also seeing a large number of FHA borrowers stay in forbearance longer than people have been anticipating. Last slide, then I'd love to open it up to questions. The good news, again, from the very rapid growth that we saw in home prices for so long, was that for owners who lived through that time period, they've just accumulated an unbelievable amount of home equity. So the aggregate number is up to about $35 trillion. You can see how rapidly it's increased in recent years. And as a result, again, both a much stronger balance sheet position for a lot of these homeowners. But at some point, you think they're going to pull that equity out sort of one way or another, either sell the property and use it as a down payment for a move up, or move to some other home, or draw that out through either a cash out refinance or a home equity loan. So I think from an industry standpoint, having a homeowner in strong financial position is great, but also knowing that this may be the spur that leads to some additional transaction activity over the next several years is very good as well. So I'm going to be sharing these presentation materials with y'all, so you can reach out to me with any questions you have. But let me stop now. I was able to do it. Cool. And see if anybody had any questions.
Go ahead, Greg. Are you raising your hand? Greg, can you hear us?
Oh.
Well, unmute yourself. Oh, well, I don't know how to fix that.
Can you put stuff in the chat?
Yeah, they're saying everybody is muted. I'm not sure how to.
Do you want to put type your question in the chat, and I'll try to do it that way?
My question, good. Can you see, Mike, can you see the chat or no?
I can.
Okay,
Big
perfect.
day for jobs tomorrow with much anticipated revisions on tap. What do you expect the market reaction to be? Oh, goodness. So I mentioned sort of market expectations of maybe a 200,000 payroll gain, but you might see the unemployment rate tick up once again. And as you note, the revisions can be really important too, because we've seen a pretty steady pattern now of prior months data getting revised down, and now this is part of an annual benchmark revision. So we might see a longer stream of fairly significant revisions based upon updated data. I think it's a source of volatility. I honestly can't tell you the direction things are going to go, but I think we've moved now from the inflation report being the most important data release each month to the job market report once again being the most important. So expect some volatility tomorrow, but I don't have a guess as to which way it's going to go.
Hey, really quick, guys, I actually found out how to unmute yourself. So, Greg, I'm going to allow your mic, I think. Will it work now? Maybe not. Just kidding.
All right, follow up. Treasury Secretary Bessent said today he and Trump aren't focusing on Fed funds, but instead the 10-year yield. Yeah, I saw that report. So during his confirmation hearing, he also got the question of, do you think that the Fed's conduct of monetary policy should be independent? So the Fed's sort of operational aspects of monetary policy should be independent. And he said yes. And the market responded positively the minute he said that. So that's sort of one side of it. So don't expect the administration to be leaning into Chair Powell quite as much as happened during the first Trump administration. But can they control the 10-year Treasury yield? Well, probably the best way of doing that would be putting out plans to get the budget deficit and the debt headed in the right direction. There's sort of an interesting sort of stat that 10 basis points reduction in Treasury borrowing costs would save about $300 billion over the next 10 years. So that's a really consequential number. So if they can do that, that's probably better than any other policy change that they could make in terms of getting longer term yields down. The other thing that he did, and this came out in the news yesterday, was prior to him being named as the nominee, he had made comments about wanting to lengthen the maturity schedule for the Treasury debt. And he had his first opportunity to do that yesterday, and he passed. So with the maturity offerings for Treasury auctions over the next quarter, he actually brought it back a little bit from what markets have been anticipating. So it sure seems like he's quite sensitive to anything which would either be negative and push longer term yields up, or the potential for some of this positive news which could bring it down. And given how closely mortgage rates are tied to the 10-year, I think that's good news for our industry. Hope that helped, Greg.
Since we're having technical difficulties with our mics, I'm not sure how to unmute everybody. If you have a question, just raise your hand, or put your, well, I guess don't raise your hand, just put your question in the chat. Suki's got one.
Yeah, so on your FHA delinquency chart, do you have the data to show the DTI credit score metric of those making late payments? Yes, FHA does present their delinquency data by credit criteria, and yeah, exactly to your point, you're seeing most of the driver is a larger share with high DTIs and lower credit scores. So whether that's going to lead to any policy change, or are we going to be back to a world where more lenders are putting in overlays, I think that's a good question. But I don't have any information on that yet, but I think that's a reasonable guess as to how folks might react. For those that didn't see Greg's question, my final question: which state is your favorite to present to, and why is it Arkansas? It's clearly Arkansas, and you guys are fun and ask great questions. So thank you for having me, and I appreciate the time. And as I said, don't be a stranger. feel free to reach out with anything else, and hope your business fares well this year.
Thank you all for joining. And Michael, you're going to share the slides.
Will do.
Okay, perfect. And we'll get the slides out to y'all. So
See ya.
y'all have a great day. Thanks.